I think I'll have to reduce the music a bit, the background music. So good evening, everybody. Yesterday we spoke about, we started talking about structure, right? We are picking everything from the beginning. We are picking everything afresh, everything afresh from the beginning, right? And all of that, right? So it's going to be an amazing time, right? Being together, right? So tonight we want to continue from where we stopped, right? Want to continue from where we stopped from. So yes, I gave my, and in fact, I was not really so chanced. Honestly speaking, I was not so chanced. So there was no way we could have done that. The best thing I could have done was to communicate to us with the fact. This is just one of those days where I don't really have the opportunity to get on my phone. Right? So those who have my WhatsApp number would have figured out that for some days now I've not really been like actively posting on WhatsApp. That right. So yeah, so I think I did today just to make people know that this guy is still here. Right. So good evening, everybody. We started yesterday talking about the basics of structure. So we're going to be reiterating a few things, right? Which is very, very important in our learning, right? So I hope many of us are already rounding off our trading for the year, right? So let me quickly say this, right? You can round off your trading for the year on currencies, but you can move to synthetics and crypto because the banks are actually doing their books, right? So I'm not part of the party that will tell you that it is the banks that move the market. There's no bank that has the ability to move the market, right? What moves the market is they're called liquidity providing houses, right? Liquidity providing houses like Fedwire and others like that. There are like three liquidity houses that provides what they call it is they call it a liquidity injection, right? So that is what moves the market, not JP Morgan, not Chase Bank, not Central Bank or anywhere. Those people don't move the market. People who move the market are the liquidity provider. So, the year is coming to an end now. They have staffs and employees that are responsible for all of these things. So, you know what they are going to be doing, closing their books for the year, blah, blah, blah. So, you see less volatility in the market, lots of ranging markets this period, and all of those things, some kind of funny moves are going to be occurring in the marketplace. So it's okay to do your close for the year, for currencies. You can move to synthetics and what do we call it now? And crypto as well, right? Just to make sure you keep yourself abreast, right? So yesterday, I hope that's clear enough and I was able to state that clearly. Right? Sorry, please. I have it. Okay, so yesterday we spoke about what we call structure, right? The basics of structure. We said we have what we call the structural formation, two major structural formations where we have the bearish structure. Price begins to continually create lower lows and lower highs, creates lower lows and lower highs, and all of that, right? And all of that. See price continue to give towards higher highs and higher lows, right? So one of the things we also said, we also dealt with how we can actually navigate our way through a ranging market, right? Because that is a type price tools that whenever you see that the market is actually ranging, right, or consolidating is the word. The primary purpose of the consolidating market is that it's actually to engineer liquidity at the top, and also engineer. You made mention of two ways to actually play a ranging market. So the first way we spoke about is that context. And to add more context to your trading, the first thing you're paying attention to is where is price coming from the left. Number two, we are looking at the most recent breakout to the upside. What's happening? Really? Okay, hold on. So just give me a minute. The messages from the chat box distract me. Let me find a way about it. Uh, So can we hear me now? So to add more context to the trading, right? We have already said that one of the things we always want to do is that we want to pay attention to where price is coming from the left-hand side. right? We want to look at where price is coming from the left-hand side. That is context one. Number two, we want to pay attention to the most recent breakouts that led to this ranging market, right? The reason is because the liquidity that's operated at the consolidated low is what is going to serve as our engineered liquidation. We expect price to manipulate the low, come back to the key level, and price will continue to move to the upside, right? So we also approach a ranging market, right? The second way we can approach a ranging market, we said every time the market is actually ranging, right? What comes to our mind at first is that the market is ranging because it wants to engineer liquidity either at the top and also at the bottom or the high, play out from the nearest key level and continue to move to the upside, right? So, and the second way we spoke about is that, after price has consolidated for a very long time, right? The primary purpose of a consolidating market is to actually engineer liquidity at the top and also at the bottom. So if price also, the first thing we want to add is that we are looking to the left as always, right? We are looking to the left because we want to pay attention to where price is coming from, number one. We're also paying attention to the most recent breakouts that led to before the ranging market started. So in this type of situation, right, we have this particular break to the upside. The next thing we want to see is that all of these levels at this top are created for us, this engineered, this particular liquidity at the top, consolidated high. One of the things we will see that price will do is that the second approach to it is that we're going to have like an impulsive move to the upside. That impulsive move to the upside is going to break above all of these highs here, right? So the next thing we want to do is that the most recent A-shaped key level that got disrespected, right? So we expect price to give to us a single candle formation as internal range liquidity. The price will continue to move to the upside. So the first approach is that after a breakout to the upside, right? The second approach is that after price, you see price begins to accumulate. Price will not manipulate any of those lows. We'll just see an impulsive move to the upside, take out all of those highs. Price will close above it as a body. Then the next candle that is going to form is going to serve as internal range liquidity. So what that means for us is that we want to see that liquidity taking and price continues to move to the upside, right? So we're trying to reiterate all that we have been saying, all we said yesterday about basics of structure. And also for the basics of structure, we said in a bearish market formation like this, every time the market keeps creating lower lows and lower highs and lower lows like this, right? We said that every lower low that is being created is an external range liquidity. External range liquidity. Every lower high that is being created is going to be treated as two things. Number one is going to be treated as internal range liquidity, and is also going to be treated as a structural point. So and also price is going to use the lower highs as a structural point, depending on how the candle closes, right? So candle closure matters a lot to us here, right? How the candle closes actually matters so much to us. So if price takes out this particular lower high, closes above it as a body with an impulsive move, it means that this structural, what price did was that price treated this lower high as a structural point, broke above it, price will come back to that A-shaped key level that got disrespected, and all of these liquidities to take them out. Do you understand, right? So, but if we have a structure, bearish structural formation, every lower high is going to be treated as either an internal range liquidity or a structural point, which means that if price takes out this internal range, this lower high, and it closes below it. So the only thing we can spot here is that we had this weak. What price came to do is to sweep liquidity here. If it closes below that particular level, it means that price used it as internal range liquidity. But when price closes above a structural point, it closes above a lower high with a body, let's say after an impulsive move, it means that price has broken above the structural point. So what that means for us is that that is where the concept of break of structure actually came out from, right? When we say something broke structure, it means that price was actually bearish from the left, and as price was bearish from the price broke above a particular structural point. Sometimes a break of structure could be above one or two structural points, right? The price breaks above 1 and 2, which means that the moment we have a break of structure for 1 and 2, it means that price will continue to move. So what break of structure just means is that price closed above 1 or 2 structural points and is ready to shift the directional bias point, which is this first lower high and this second lower high. The moment we break above it, it means that the overall directional bias from the left, which was bearish, will not like this. Then price will continue to give to us higher highs. So the difference now this is where the difference between, because when we begin to get even more intimate in what we do, right, you will figure out that you're going to be hearing some words a lot, breakouts, most recent breakout. But you will find out that from this particular chart here, right, you can see the structural formation, lower high, lower low, lower high, lower low, lower high, lower low, lower high, lower low. We broke above 2 structural points, closed above it as a body, right? The moment this was where the break of structure happened. Yeah, all of these are just most recent breakouts, right? And the reason why they are most recent breakouts is because from yesterday's call, I said to us that every higher high is going to be treated as an external range liquidity. And what price seeks to do is that price seeks to take out from external range liquidity, come to take out internal range. From internal range, price will go to the most recent external range, right? From internal range again, and price will continue to move in that regard, right? So the first place you can actually spot was the break of structure, but all of these breaks here they are called breakouts because price broke above the most recent high, created a new high, which is going to be the new external range liquidity, came for this internal range liquidity and all of that. So that is one of those things we're going to be covering today, right? So yeah, so I just had to quickly reiterate for many of us that we be interested. Hold on, please give me a minute. So now, when it comes to the advanced side of structure, right? I personally, like I've said it a couple of times. There's nothing really advanced about structure per se. To me personally, I do not like to use the word advanced, right? Although there could be something like that. So what people just actually mean by the word advanced many times is just say like there is more to actually this type of thing, right? So now, when we talk about when we talk about the advanced part of structure, so basically what we're just talking about is that the advanced part of structure just simply tells us the major responsibility of the market, right? And there's only one responsibility of the marketplace. So that is what we're going to be talking about when it comes to advanced structure. So for advanced structure, this is what people just actually need. For the basics of structure, price in a bullish market condition, we expect price to just continue to give to us higher highs, higher lows, higher highs, higher lows, higher highs, higher lows, right? If this is how market forms, right, everybody would have bought a Lamborghini by now, right? But there's something I wanted to have at the back of your mind in the basics of structure is that every higher high is going to be treated as external range liquidity. This is going to be treated as an external range. This is going to be treated as an external range. All of these are external range liquidity. Every higher high in the basics of the market structure are external range liquidity. And one of the things I want you to hold at the back of your hand is that after every external range liquidity is taken, we must always see a reversal. And after every internal range liquidity is taken, we must always see a continuation or an exchange liquidity that is taken. We'll see reversals for every internal range liquidity that is taken. We'll see expansion. So that is like the basic side. That is like the basic side of structure that I want you to hold on to. So, but when it now comes to the subject of the word that people love to use, like advanced structure, when it comes to that particular regard, so what they just try to say, let's you. So basically, what they're just trying to say to you is that after price creates a high, right? Price moves, creates low, higher, high. Price creates another has been created to serve as internal range liquidity, right? Then at some point, price is going to engineer its own liquidity like this, continue to move like this, right? Price is going to create internal range again. After taking out the external range liquidity, price is going to come back for this, and all of this. So when it comes to the subject of advanced structure, this is what people say an advanced structure is all about, right? Now, the summary of all of this advanced structure is in just one sentence. And that one sentence is just to let you know that the price is always coming to take out internal range liquidity. Every higher low that is being created, price is going to take out internal range liquidity, the engineered internal range liquidity as well, right? All of this internal range liquidity that is being created. So the subject of advanced structure is just to let you know that if price was just creating a series of higher highs and higher lows, in fact, there's no other thing you need to learn. When it comes to this is how the market prints, because this right here that you see right here, this is theory, right? The real work is to be able to understand this framework of structure. And I've simplified everything, which is something we're also going to deal with. I've simplified everything, all of this internal range liquidity that is being created, this one that is called the engineered liquidity. I've summarized everything, which is something we're going to talk about, into what we call the single candle formation as internal range liquidity, right? So this right here that we see is theory. This right here that we see is what we always see in the chart, right? This is the reality that we see in chat, right? The moment you're able to interpret all of this, right? You have your issues 70% solved. So the market does not always print out something like this. What the market is always going to deliver to us is what we call this, right? So what price is going to do, remember what I said, that every higher low that is being created is going to be treated as internal range liquidity, right? Every higher high that is treated is going to be, every higher high that is created is going to be treated as external range liquidity. So this right here is an internal range liquidity. This right here is an external range liquidity. This right here is an internal range liquidity. This right here is an external range liquidity. Now, the concept of advanced market structure is summarized in this one sentence, that price is always looking to bounce from one form of liquidity to another, meaning that after price takes out an external range liquidity, right, we expect to see a reversal. The moment we have that reversal, after price takes out the external range liquidity, price is looking for the nearest internal range liquidity to create, right, to take out. The moment price takes out the internal range liquidity, we're going to see an expansion to the upside. So the concept of it is taking, we want to see a retracement. After every internal range liquidity is taken, we want to see an expansion. Now that we have seen an X to one thing, it's going to lead us to the next external range liquidity. Next external range liquidity is this particular liquidity. And after we take out the external range liquidity, what do we expect? This phase of advanced market structure, right? The first phase is just where price will create for you internal range liquidity. Price will take out that internal range liquidity and continue to move market structure. The second phase is this. Let me show you. Let me explain this. So this is the first phase of advanced market structure. Price creates a series of higher highs, higher lows. Then price will take out the internal range. After taking out the internal range, price is going to move to take out the external range liquidity. So we have this. This is the first phase of advanced market structure. There are times where price is going to engineer its own internal range liquidity, because at the end of the day, advanced structure, we've been able to sweep this particular low, right? After sweeping this particular low, we have our most recent breakout to the upside. So this means that this becomes a strong low for us. When we get to range tackle, we're going to deal with all of that. So we have this particular low as our strong liquidity. Automatically, we expect price to come to take out internal range. But because this is going to be treated as a strong low because we swept liquidity and broke structure, right? So now, in this type of situation, which is the second phase of advanced market structure, right, we expect price to come back to take out this particular low. But this is where we now call where price engineers its own liquidity. In this type of regard, in this second phase of advanced market structure, it is the easiest way to understand that price is going to engineer its own liquidity, or price has engineered its own liquidity, is that we would see that price. Now, remember we took out this internal range liquidity and we expanded to the upside to take out this external range liquidity, right? So our new trading range is going to be from this low to this most recent high that is being created. So we're dealing with this recent from that low to that particular high. This is the trading range we are actually dealing with. So in this type of regard, one of the ways that price has engineered its own liquidity after taking out the most recent external range liquidity is that price will trade higher, but it will not take out this external range liquidity, right? The moment you see price trade higher like this and does not take out this external range liquidity, the next thing you will see is that this low that has been created is going to be used as your internal range liquidity. Once you see price come back, take out that particular low, right, and clear out from a particular key level and then move straight to the external range liquidity. So this is where we now call the second phase of advanced market structure, because at the end of the day, it still brings us back to what we expect price to always do, right? We always want to see price attack liquidity, right? In advanced market structure, the concept of advanced market structure is just to let each one of us know that price is always looking to move from internal range to external range, right? From external range, price will move forward to internal range. That internal range liquidity could be engineered, right? And one of the ways that an internal range liquidity could be engineered is this. After price has delivered for you the first phase of the structure, creating higher high, higher low, higher high, price will come, take out this particular higher low, then go to the upside, right? So now, like I said, the two major phases, right? The major range now that we're paying attention to is going to be this low, right? And it's going to be that high and this low, right? The reason is because the first phase of the advanced market structure has been delivered. Why? Because price came to take out this particular internal range liquidity, and this external range liquidity has been delivered. So one of the ways you get to know that price has engineered its liquidity is that you will see that after the external range liquidity is taken, the basics of market structure say that after external range liquidity is taken, we want to see a reversal, right? So generally, we expect to see some kind of level of reversal. So one of the ways that internal range liquidity is being engineered here is that price will trade lower, but it will take out this low. Then you see price will give to us an impulsive move to the upside, but it will take out the most recent high. This is the most recent external range liquidity. The moment you see that price has traded higher and has not taken out this most recent high, and you begin to see price drop like this, just know that the moment price starts to drop, price has already engineered its own internal range liquidity, which is going to be the lowest low inside of this entire range. So the lowest low inside of this entire range from this high to this low, this is the lowest low. That lowest low becomes our internal range liquidity, or engineered liquidity as people choose to call it. So what do we expect price to do? Take out that particular liquidity, play out from the V-shaped key level, and we expect momentum to kick in, right? The moment this second phase has been delivered, we can now have a repetition of the first phase again. What that means for us is that price is going to create for us this again. Price is going to repeat itself and continue to move to the upside. So the primary understanding of advanced market structure, right? The reason why people brought about the word advanced market structure is that when it comes to the reality of the marketplace, the market is never going to be higher high, higher low, higher high, higher low, right? But you know that if you understand SLK to some point, right, you can still you can see market in this light on the higher time frame where price just gives to you higher high, higher low, higher high. The only thing you're paying attention to here is, let's say on the 4 hours time frame, is your most recent breakout. You're waiting for liquidity to be engineered and play from the nearest key level and continue to move to the upside. So you can't downplay the basics of structure. For example, price breaking above the most recent high, breaking above the most recent high. Because the moment price breaks above the most recent high, it means that the trend is still bearish. It breaks above the most recent high, closes above it with an impulsive move. It closes above it with a body from with an impulsive move. It still tells us one thing. It happens on the 4 hours time frame, right? So it tells us that price is still very much bullish, right? So now, we said all of that to say this, that when it comes to the subject of advanced market structure, right? It is just to let us know that the market is not always going to give to you a picture perfect move like this, right? You must train yourself. You must train your eyes to be able to see that when it comes to the marketplace, price is always looking for one liquidity to another to attack, right? Price takes out external range, it will come for the next internal range, and it will go for the next external range. The price is going to engineer its own liquidity inside of this trading range from this high to this low, right? And now one of the ways you know is that the moment external range liquidity has been taken, price will reverse. The moment you see that reversal, sometimes it will be a heavy momentum push to the downside, right? Price will trade lower, but it won't take out this low. Then price will trade higher, but it won't take out this most recent high, right? So what is happening here is that in this second phase of the advanced market structure, what price is doing is that price is looking to engineer its own liquidity. So the moment you see that price has traded lower, it can't take out this low. If that's traded higher, it can't take out this particular high. One of the things you will see that price begins to do again is that price will begin to retrace. The moment you see price begin to retrace is that it means that liquidity now has been engineered, right? Because price needs to satisfy that full condition, right? So what is the full condition that price needs to satisfy? We took out external range liquidity, we reverse, take out internal range liquidity, we expand, take out external range liquidity, we give to us a reversal, then price would engineer its own liquidity again here, then price will take out this one, then give to us an expansion. The reason of the expansion is for price to attack the most recent external range liquidity that has been created. So the subject of advanced structure is that price is just moving from one point of liquidity to another, from external to internal, from internal to external, from external to engineered internal liquidity, from that again to the next external liquidity as well. And this is how we want us to continue to build the marketplace. Do we understand? So I hope I'm not too fast. This is just the basics, so we've not even got into the main thing. I hope I'm not too fast.
No, you're not. No.
Thank you. Let's look at some chart examples, right? We have about 5 minutes left, but I'm going to send another link so that we can, right? So I'm going to be sending another link, right? We have just 4 minutes left here. So when you look at, let's use this GBP JPY as our first example. But when you look at GBP JPY, right, I've said it over and over and over again that the weeks should not even be a problem because the stories in the bodies, right, weeks should never be a problem. So if we want to use basics of market structure to look at this, for example, move to the line chart, you can see the structural formation here now. Basic, this is very basic, lower low. When you look at the structural formation from what we can see here, we had this lower low, right? We have this lower low, we have this lower high, we have this lower low, we have this lower high, we have this lower low, we have this lower high, lower low. Did you notice one thing in common for all of this? Price breaks out from the lower high, which is the external range liquidity. It gives to us a reversal. Maybe price came back here to take out an internal range liquidity. We have an expansion for price to take out this external range liquidity. Then after taking out this external range liquidity, you can see the reversal. We came back for an internal range liquidity around this spot. Then we gave to us a breakout again. All of this breakout from this external range liquidity and advanced market structure just tells us that price is still very much bearish, right? So we are just looking for buying opportunities. It could be for that day, it could be for that week, it could be for that particular month, right? So if you look at what price begins to do from here, now you can look at this, right? Now let's even pick it from this place is better, right? I don't want us to go ahead of ourselves. So when you look at what price did here, move to the line chart, what will you find? We have lower low, lower high, lower low. So you can see the breakout, right, happened here. It means that we are still very much bearish. So if this says we are still very much bearish, right, you can see the structural formation. We broke out, right? So what do we expect price to do? Take out internal range liquidity, right? Then move straight to the external range liquidity. This would have been a very good place to take out as our external range liquidity. Do you see what price did here? Look at where price came back to. Price came back to the A-shaped key level that got created, right? Price came back to this particular A-shaped key level that got created, this one. The moment price came back to the A-shaped key level that got created, can you see what price did next, right? Price went for the nearest external range liquidity that is resting here, right? And the moment price went for the nearest external range liquidity that was resting here, we had a breakout to the downside. So when you look at the structural formation of what price now did again, price now gave to us what we call the advanced market structure. So what did you notice that price did here? Look at this. We have the slower low, we have the slower high, we have the slower low. One thing is common amongst them, right? We broke out from the downside, we broke out to the downside. So when you look at where the liquidity was actually engineered from, you'll find out that this is where liquidity was engineered from. No, this was not the liquidity that was engineered. This one happens to be every lower high that is being created is going to serve as an internal range liquidity. So this is the most recent lower high that was created. When you move to the body, this is where the lower high is, down here, right? But because of the week, because everything tells a story altogether. So one of the things you will notice that price did is that after price took out this external internal range liquidity, we came back to our A-shaped key level again, right? And after coming back for our A-shaped key level, we need to satisfy that full condition. The first external range liquidity that we need to see price take is going to be this particular one. And the next one that we wanted to see price take was this particular node 2. So if you look at where price is actually coming from, okay, we have less than 1 minute. Let me stop this recording. I'm going to send a new link to all of us, right? So join when you can.